Hi everyone. Are global market shifts and the future of the US dollar weighing on your mind? You've worked hard for your wealth, and concerns about economic uncertainty are completely understandable. Many of our viewers, just like you, are looking for true peace of mind and lasting security. That's why tangible assets like physical gold and silver are becoming a crucial choice for wealth protection and legacy preservation. If you're thinking about how gold and silver could help safeguard your retirement, we invite you to take the next step. At ITM Trading, trusted for almost 30 years, we're here to provide clear, honest information. So take advantage of our free, no obligation consultation with one of our experienced analysts. It's a friendly conversation to explore your options, answer questions, and see if precious metals fits your goals. Call us or visit DannyReport.com to schedule your time. Asia is moving away from the US dollar as a mix of geopolitical uncertainties, monetary shifts, and currency hedging prompt de-dollarization across the region. Recently, the Association of Southeast Asian Nations committed to boosting the use of local currencies in trade and investment as part of its newly released economic strategic plan for 2026 to 2030. So although this shift is, you could argue is more pronounced in Asia, the world has been cutting its reliance on the greenback, with the share of the dollar in global foreign exchange reserves now declining from over 70% in 2000 to 57.8% in 2024. Here to talk about this and more is Marko Papic. He's the chief strategist over at BCA Research. Marko, always good to be with you. Welcome back.
Thank you so much. It's a real pleasure.
Yeah, so obviously I want to get your comments here on this latest report coming out of Asia. The plan outlined efforts to reduce shocks associated with exchange rate fluctuations by promoting local currency settlements and strengthening regional payment connectivity. The point is, more and more countries are looking for solutions outside of the dollar. What's your take on this?
Well, Daniela, you already said what's been happening since 2020. You noted that the share of US dollar in currency reserves has declined over the course of 25 years. However, during those 25 years, the dollar has gone up, it's gone down. And so the US dollar's share of global currency reserves is not related to whether the dollar is expensive or cheap or going up or going down. So I would argue that the dollar will go down. It will go down substantially over the next 5 years, but it's not really related to its currency reserve status. It's related to the fact that the US economy is unlikely to outperform the rest of the world the way it has since 2020. And that's a function of fiscal policy, which juiced American economy beyond its means from around COVID. But really, you could even argue the 2017 tax cuts by President Trump that were unfunded, were expansion of the deficits. That's coming to an end with what is inappropriately called the one big beautiful bill. Now, the currency reserve stuff obviously matters, and I think it's a tailwind to my view, a headwind to the price of the dollar. But yes, I think the currency decline is going to be more than just the reserve currency issue.
Oh, and you're right. Since the start of the year, the dollar index has weakened by over 8%. But you're making a very important point. What the dollar does, its fluctuations, is one part of the equation, and reserve status is another part of the equation. Um, do you think its reserve status is truly at risk? I'm talking 5-year window here.
I think the probability of there being a dramatic risk, a run on the dollar, has increased, obviously. When President Trump puts tariffs on penguins, when there is an erratic policy, when there's threats of taxing financial flows into the US by foreigners, those have all increased the risk of some sort of a dramatic loss of reserve currency status. But we've also witnessed President Trump, make U-turns towards more sort of coherent and, establishment policies, if you will. Trade deals are being made, and there has been no tax applied on foreign flows into the US. There's a very important part of one big, beautiful bill. It's called Section 899. It's caused a lot of my clients in the sovereign wealth fund, pension fund space to really be concerned. It appears that it's going to be delayed, its implementation. It might even be removed from the bill. So I do think the probability of some sort of a loss of reserve currency status has increased from, let's say, 2.5% to maybe 10%. But it would not be my base case. I think my base case is what you already said, which is that US dollar has declined in use in reserves from 70% to about 59%. I think by the end of this decade, we're at 50, maybe slightly below it. But the one aspect of reserve currency status that's difficult to lose is its use in financial transactions. So not trade, not being used as a source of store of value in vaults of central bank,
Right.
but pricing other assets. There's just stickiness to that, just network effects. And so that's something the US dollar is unlikely to lose, on anybody's investment horizon over the next 10 to 15 years. It's going to continue to be used to price commodities and other goods.
In your recent note, you write, yes, the US is still adding to its deficit, but the pace at which it is doing so has moderated. The point you say confuses investors. Is the US fiscal deficit not still expanding? Explain, Marco.
Well, so we don't actually know. It depends on whether tariff revenue is going to bring in enough. Um, if you look at the one big beautiful bill, it's been scored as adding about $2.5 trillion over the next 10 years, which for an economy the size of the US is not that much. The most pessimistic scenario I see related to scoring this bill takes the US deficit from 6.4% of GDP to 7.3. Mm, you know, the most optimistic one actually declines the deficit to 6% over the 10 years. So I would say that this bill is relatively neutral on adding new expansion of the deficit. Now, that's not to forget that the deficit is very high. It's 6.5% with no
Okay,
recession,
right.
right? But like, it's not going to add more to it. Now, there's two ways to think about this. I'm not trying to like justify it. I'm not trying to defend it. I'm just stating the facts, mathematical
Yeah.
facts. Another fact is that what matters to growth is not deficits. It is the change in the cyclically adjusted primary balance sheet. So it's the change in the deficit. And most investors just don't think about it this way. But the
Mm-hmm.
deficit doesn't matter for growth. You can have 800% of GDP deficit. If it's just flat at 800%, you're going to go bankrupt, but you're not adding to growth. And so this is important. This is not a pro-growth bill. It will not add any growth to the US. The largest component of the bill is actually maintaining taxes the same. It's not adding new tax cuts. The $4.5 trillion that it costs to extend the 2017 tax cuts. But just think about what that means. If you're a tax resident of the United States of America, as I am, it means nothing. You're not putting more money in my pockets. You're just making sure that taxes don't go higher. And so this is very important for investors. This bill does not add to growth in any way, shape, or form. And if that's the case, then expectations of US growth relative to the rest of the world are overstated, which means that the US dollar as a currency is way too expensive and has to decline.
Let's talk monetary policy now because JD Vance adding to Powell's pressure here, saying the Fed is committing malpractice. They want lower rates. Are they going to get it, in your opinion?
I think yes. I think over the next 6 months we're probably going to have cuts. And the reason for that is that inflation does seem to be well behaved, which is positive. Um, Hard data is looking pretty strong, but there's some softness in the labor market. So yes, they are going to get cuts. Where I disagree with Vice President Vance is that I'm not sure it matters. Remember, the Fed cut rates by 100 basis points from September onwards last year, and the long end of the curve, the 10-year yield, went up 100 basis points. That hasn't happened in US recent macroeconomic history. It actually hasn't happened in 50 years, where the Fed cuts rates, but the long end goes up. Why does that matter? Well, it matters because everybody listening to this interview right now borrows money at the long end, not the short end of the curve. The Fed controls the curve through the short end, but if the long end doesn't respond to their cuts, then did the cuts really did they happen? No, they didn't matter at all. And that's why I don't think the monetary policy matters at all. What matters is fiscal policy. What matters is trade policy. What matters is whether President Trump and his cabinet are going to implement orthodox, sane macroeconomic policies. If they do, the long end will come down, and that will be good for the economy. But that's not going to be something that Jay Powell can do magically by himself.
Okay, but doesn't it does matter if they start printing away though, Marco.
So that's a different point. That would be QE. That's unrelated to cuts. The point that JD Vance was making in your question is, hey, they need to cut. If they do restart QE, obviously that would suppress the long end, and I'm comfortable with that. What I mean by being comfortable is I'm positioned for it, and what I mean by that is that I do not want to play the yield curve. I don't think that you're going to make any money by expecting a blowout in bond markets. It's a very dangerous position to be in, being short duration. Instead, you should expect currency decline. Because if they do start printing and suppressing the long end, currency is going to decline. So no matter what they do, whether they're fiscally prudent, as I think they've actually started to be, whether they print money and they're imprudent, no matter what American policymakers effectively do, the US dollar is likely to go down 25 to 50% over the next 5 years. Now, that might sound nebulous to you. Like, what do you do with that information? Well, you should probably book your European vacation right now. Right now. But other than that, what I would say is that currencies, large currency moves lead to flows. And so if you start seeing the euro or emerging market currencies appreciate, that will attract flows into those countries. So you need to start diversifying your portfolio out of the US. And most people listening to this are probably 90% overweight US assets. You need to let your hair down and spend some of the money you made in Magnificent Seven, take it and go shopping outside of the US with equities, with bonds, currencies. Just expose your portfolio to non US assets.
And how about gold? Where does gold fit into that equation for you?
So I've been
Does
very
it?
bullish gold since January of 2023. I think gold probably has more upside, but I don't expect it to go up as much as it did last 2.5 years. I think that there is going to be a little bit of a loss of momentum for gold. But yes, and generally speaking, gold and Bitcoin are obviously also alternatives to the US dollar. But just keep in mind something: gold and Bitcoin don't have a yield, they're just a way to basically diversify your currency portfolio. But you also have to diversify your equity portfolio, your bond portfolio. And you can't do that with gold because gold yields nothing. And so because of that, I think that gold has more upside, but not necessarily a ton of more upside. So you should not diversify your equity holdings. You shouldn't sell your Magnificent Seven stocks and buy gold. You can sell some dollars and buy gold. But when it comes to equity rebalancing, you should be looking at non-US equities and non-US bond markets as well.
Just one more point I want to get in from your newsletter. You say a new world order. You write a short note on why President Trump's May 13th speech in Riyadh you say is the most profound foreign policy speech since George W. Bush's New World Order address to Congress in 1990. How so, Marco?
So George H.W. Bush, George H.W.
Sorry, George H.W. Bush's.
Yeah,
Sorry.
Bush Sr. So Bush Sr. made a speech in 1990 where he effectively created this view, this foreign policy of the U.S. that U.S. just because the Cold War was over, U.S. wasn't going to retrench. It wasn't going to, you know, withdraw. Instead, the U.S. was going to impose on the rest of the world a hegemonic unipolar new world order where the U.S. is in charge. It's basically a benevolent hegemon, and everybody else is a vassal state of the U.S. And that's worked for basically 35 years, more or less. That's what the U.S. foreign policy establishment has imposed. For the past 10 years, it's been very difficult to impose it because the world is no longer unipolar. Other countries have risen in terms of power. And so President Trump is really the first president that has recognized the limitations of American power. And in May, in Riyadh, he effectively said that, the US is going to pursue its interests. It's not going to impose its worldview on the rest of the world. You guys can do whatever you want, effectively, paraphrasing what he said. And that's really profound because it means that geopolitical equilibrium will be easier to establish around the world, whether in the Middle East, in the Ukraine conflict, over Taiwan, because America has effectively gone from a worldview where it doesn't recognize other countries' spheres of influence at all, doesn't accept them,
Hmm.
to accepting that they exist. And that in of itself is very important because it means America is now open to negotiating where those spheres of influence begin and where they end. So, just to be very practical in terms of what this means, in Ukraine, the US has gone from saying we don't recognize Russia's annexation of these territories, it has to return them all, which will obviously never happen, to like, okay, fine, you can keep some of them, but we're going to negotiate where that line, we're not just going to give you what you want, we're going to negotiate with you using sticks and carrots, and then we're going to delineate where Russia's spheres of influence starts, where the West's uh where Russia's sphere of influence ends, where the Western sphere of influence starts. So that's important because it actually increases probability that we find a geopolitical balance. And so I'm actually not bearish about geopolitics over the next 5 years.
That's somewhat promising. Marko Papic, thank you so much for joining us today. I appreciate your thoughts.
Of course, it's a pleasure.
And thanks for watching. I'll have more content coming your way. Be sure to stay tuned to the Daniela Cambone Show here on ITM Trading and subscribe to our channel. Thanks for watching.